As part of our currency value analysis, we also talk about fundamental analysis. And the technical analysis and fundamental analysis actually go hand in hand. And even though many technicians prefer not to know much about the fundamentals, therefore their perspective of analysis should not be biased. In cases of foreign exchange, because you have two separate currencies, which kind of makes the analysis a little bit more complicated, and also the efficiency of currency markets compared to the stock markets, in my opinion, makes it more imperative that we talk about fundamental analysis along with the technical analysis. So what I'll do is I will actually just put a moving average, a simple one, and then let's make that a long-term moving average. So maybe something like a 200-day. And because it's a 200-day, it is a long-term investor perspective, if you will, or investors or traders' overall perception of how where or how they feel comfortable with respect to the exchange rate. So, all since the COVID, you actually have an exchange rate, and notice I have an exchange rate right now in euro to the dollar, meaning how many dollars does it take to buy one single euro? And dollar has been, so if this exchange rate is up, that is dollar losing value, and this is coming down means the dollar gaining value. So notice how the dollar, the exchange rate was actually above that 200-day for a significant period of time, which means that the dollar was losing value almost immediately after the COVID crash. And, at one point, when the Fed said that they noticed their inflation expectation is not transient and it's more permanent, and therefore they need to fight with it and change from dollars to hawkish monetary policy. And they started increasing interest rates. And as they started to increase interest rates, the exchange rate started to decline and dollars started to gain in value. But at the very same time, you actually see the ECB, the European Central Bank, also increasing their interest rates. However, I think they've actually had a significant delay after the American Fed. So what do we mean by fundamental analysis? Well, the fundamental analysis basically looks at fundamental facts, political, economic, monetary, financial events, facts, news, information, and how it affects the exchange rate or how it affects the price compared to, in our discussion, compared to the technical one. So, we do not want to evaluate each independently, but we want to have an explanation that would include both most common and most familiar, and therefore the self-fulfilling prophecies, and also the most prominent events that took place, and therefore the technical analysis and fundamental analysis combined. So from this perspective, when you look at news from, say, June of 2020, where the exchange rate was declining, and then the COVID crash last year, and then from June 2020 all the way till the June 2021, dollar lost value significantly, and that potentially is because of inflation. So now we actually added the fundamental analysis into our technical analysis, and then we see that the dollar started to gain in value, and this was a rather faster value decline compared to the 200-day moving average. And that probably is because of the exchange rate, because of the interest rate increases and monetary policy change by the Fed. So now we again, um, you know, combine the technical analysis with our fundamental. So it's a great help to know the events, the economic activity, and significant um, macroeconomic information about the currencies you're evaluating. Because this is a fundamental analysis of an exchange rate, it actually involves two countries, two currencies. In this example, which, again, we've gone through dollar euro for your assignment. For this specific one, I'm actually evaluating the US dollar and I'm evaluating the euro. But my evaluation is one currency versus the other. So how could it be that the euro value can change with respect to the value of the dollar? So the knowledge of what's happening in the US is significantly important in analysis of how euro exchange, how euro value change with respect to the dollar. So for instance, if you were evaluating, say, euro to the Japanese yen, that would require you to discuss the macroeconomic and financial events that are happening and that you expect to happen in both the euro as it relates to Japanese yen and in Japanese yen as it relates to the euro. But to make things a little bit easier, a lot of the times these cross rates are a default eventuality of euro to the dollar and Japanese yen to the dollar, and therefore you are actually looking at the euro value change based on information compared to the dollar, and then Japanese yen value change compared to the dollar, and that actually makes the job slightly easier. So let's discuss. I mean, like I said, the idea is to give you an example of what needs to be done for our assignment or for, in general, how to do an analysis report for an exchange rate. So from a U.S. perspective, we obviously have one of the easiest indicators, and that's the financial markets. And I think for the past 2 years or even 3 years, we have been laser focused on the Fed monetary policy. So much so that the Fed has been increasing interest rates so much. And because of that, we had banks like Silicon Valley Bank fails. The bond yields are changing as we've never seen them before. I mean, this is the Vanguard Total Bond Market ETF, and how the price is going down. That means the yields are going up. And this, we have seen bond prices decline, obviously, but such volatility in bond prices is, in my opinion, unprecedented. At least for my generation, it's unprecedented. And everything started out with COVID, obviously, but then the Fed policy change was sudden, and that actually affected the bond yields and therefore the bond prices significantly. So our financial markets, as one of the biggest financial markets in the world, reflected the change in the monetary policy change of Fed, and we have this correction immediately after that monetary policy change. But from COVID all the way to that realization that inflation is not transitory, the Fed just kept a dovish monetary policy, kept interest rates low, and started to reignite the economy, to restart the economy, and therefore that had a very positive impact on the financial market. Notice, though, this financial market change from 2020 March all the way till the January of 2022, it's not really reflect on the value of the US dollar. In fact, for the same time period, sorry, this is a perfect period. So when you look at that, you do have a little bit of a dollar losing value. And then we actually have dollar gaining value, I think, after the monetary policy change of Fed. In the US, we do not have significant international political influence on our financial markets. However, the military conflict between Ukraine and Russia seems to be an influence on every economy out there, including the US. I think the oil prices, you could see the impact of oil prices in companies like Exxon, for instance. Um, the oil prices kind of reflect how the energy sector has been influenced by uh, the Ukraine and the Russian military conflict, and world food prices also, grain prices, agricultural prices have already skyrocketed, and therefore that also affects the economic stability of U.S. like any other country. So in this respect, when you're talking about exchange rate, the usual comparison is how it affects the U.S. compared to, in our case, the European Union. And in that sense, this is just an example for you to, talk about these events, not just in a vacuum, but how it actually is relative to the other countries' reaction to such events, especially these global events. So COVID, for instance, was a significant event, but some countries had it easy, some countries had it really bad. So in the US, while it was really bad and the economic activity almost came to a halt, there's a significant rural presence in the US, and I think that because of that, US recovery has been a little bit faster compared to countries who had a little bit more urban, organized living or production or infrastructure. And so I think that in my case of euro to the dollar, I think that US had a little bit better recovery from the COVID compared to Europe. But when you look at the exchange rate, it actually does not show. In fact, you see that the dollar is losing value immediately after that COVID financial crash or during the COVID burst of COVID, when we were all hunkered down. And it possibly could be because U.S. had perhaps a little more strict, rules, or perhaps, I personally would have expected Europe to fare worse compared to the U.S., but evidently U.S. dollar lost value, so I think that the U.S. in that case is more effective. So again, notice the relativity of one country's reaction to an event, a global event, compared to the other. So in an exchange rate, you have two countries, and that's imperative. So one of the things that I actually looked up was how much or how did the European Central Bank change interest rates, and they have been changing the interest rates very similar to the Fed, and this is a news piece by Reuters as of last month, and notice that they've actually done it for 10 straight time, and they have been increasing. The only thing I remember that about their interest rate increase program is it came a little bit at a delay, and that in the compared to the U.S., once our Fed decided to change the monetary policy because they deemed the inflation not to be transitory and more permanent, ECB waited for another quarter or two before they started to increase the interest rates. So there's the second problem of the Russian and the Ukrainian military conflict. And one of the problems associated with it is the natural gas that the European nations seem to be especially dependent on. And that, for any economy, the oil price or the natural gas prices and the availability of natural gas is the lifeline of any economy. So if you do not have access to natural gas because they're expensive or simply not available, then your economy becomes more, it becomes slower or more expensive. So it could lead to inflation, price inflation. It could lead to slower production because it could lower GDP, a recession, and it could also lead to dependence on other um, countries with respect to perhaps more macroeconomic dependence or political dependence or even military dependence. However, in the case of Russia, U.S. was backing the entire European continent through NATO, and however, the natural gas availability is a significant issue, and the U.S. is on the other side of the ocean, so providing natural gas for Europe from the U.S. may not be, it's simply not possible. There may not be enough volume. It could be expensive, and it may not be feasible or practical. So that's a risk number one. So when you're talking about, the impact of Ukraine and Russia military conflict, it seems to be a little bit more prominent for Europe. So perhaps one of the reasons that recently the dollar, right here, the dollar has been gaining value could be because Europe is now faced with a more significant political, economic, and you know, a military risk, a real military risk, right by their door, uh, right by their door, perhaps exposing them to the risk cutoff for many investment decisions. So, how we talked about that, the corporate trade, we said that only two things that matter the most, and that's risk and return. So on one side, interest rates are being increased by the dollar and the euro. Both Fed and the ECB are increasing interest rates. So the returns are increasing. However, you have to look at the inflation now. Whose inflation is increasing more will determine who's actually providing a higher net yield. So that's your number one. And then number two is the risk. And in this case, I would say that uh, the military conflict in Russia and Ukraine is a lot more uh, detrimental and damaging to the European economy than it is to the U.S. economy. And therefore, in my opinion, this particular military conflict is a high risk for Europe, and therefore it might actually explain why the dollar has been gaining in value significantly. I mean, look at, we came from 1.22 all the way to 2.98. So that's about 50 to 20% drop in the exchange in the dollar's value compared to euro in about 2 years. So that I think is one of the explanations. So there's a little bit more on the expected impact on European economies. And so, I mean, there's a significantly bigger impact on European economies because of the war, and the expectation is still not as well as what we thought it was going to be. And finally, I wanted to show you how, I mean, this is a study by a European investment bank, and this actually is quite nice in the sense that it shows increase in the share of firms reporting losses. And these are all in percentage points, but notice how you have, this is 8%. So in Germany, you have about 6% of the companies who actually report more, or 6% more companies report losses. And I think they actually blamed this on the Ukrainian economic shock. And this is only last year. So we have about another year in 2023, and looking forward, 2024, 2025. I mean, I'm not sure if the Ukrainian and Russian military conflict will end anytime soon. So, and now that we have the military conflict in Israel and Palestine, I think that the Middle Eastern military conflict could also have significant effect on oil prices, energy prices, and some other contagion perhaps into other countries that could be involved. And that also exposes countries who are nearby, especially in Europe. Um, so Greece seems to be at the worst case. Not sure if, you know, I personally didn't realize how much intricate Greece or how much business were integrated with Ukraine and or Russia, but it seems that they have been at a very significant um, drop. And this chart shows the yellow line as the energy and the blue as the export. So Greece is kind of hit by the energy. Very similarly, Spain is kind of hit by the energy. Croatia, Portugal, Italy, Austria, Romania, even Germany. So for the countries who were hit by exports to the conflict zone are Estonia, Latvia, Lithuania, Hungary, Poland. Nonetheless, it actually shows the impact of the you know of the military conflict on the European Economic Union or economic area. So if you look at the recent developments, by the way, what's happening in the Middle East with Israel and Palestine, the impact now you see is not as big as it is with Ukraine and Russia. This does not mean that the military conflict is of, is less significant. However, we have to look at the economic impact of these conflicts and how they would affect the area, how they would affect the macroeconomic development or recovery of countries. And not just countries that are involved in the military conflict, but the countries overall. So, a country like South Africa may have nothing to do with it. However, if the Middle Eastern conflict leads to higher oil prices, South Africa is a country who imports oil, and therefore oil prices will increase, and that would actually increase oil prices in South Africa, and their economy would become hampered. They may face a very simple recession, and they may also face inflation of prices just because the oil prices are increasing. So even though the country may have nothing to do with the military conflict whatsoever, just because of the nature of the conflict, if certain commodities are affected by this, especially oil, which is, like I said, a lifeline of any economy, then your country will be affected by this conflict. So in the case of Ukraine and Russia, we had three major commodities. I think one was wheat, and then we had oil, and then we had natural gas. And all three affected Europeans a lot more than Americans. We got affected by it too, yes, but the effect to Europe was significantly worse. So we actually see that in the exchange rate. So when we're talking about these fundamental analysis, remember that each event, we have to explain how it affects the exchange rate or how it affects the currency as it relates to other currency. An exchange rate is two currencies. So, when we're talking about, say, a military conflict, in this case, this was what happened. We are literally comparing how the effect of the conflict was to the US versus how the effect of the conflict was to Europe and how it actually compares. And from that comparison, we basically try to make sense of the changes in the exchange rate. And we build our expectations going forward by that exchange rate. Finally, I want to emphasize that we are not fortune tellers. So we basically simply put forth our expectation of what can happen to the exchange rate given our expected changes in one country versus the other. And it's never about being right, but it is always about being thorough. Even even if the predictions are wrong, but you provide thorough analysis and complete information, um, the client or the reader or the recipient of your analysis uh, can have his or her own inferences based on your explanations. They don't necessarily have to believe to your expected forecast. And again, you don't necessarily have to be correct about it, but you have to be thorough and inclusive and provide as much information and as relevant information as possible. So in the case of technical analysis and the fundamental analysis, the more inclusively of different common and major tools of technical analysis and more information of um, political, economic, financial, um, relevant information with respect to one currency and then with respect to the other currency and how they actually relate to each other makes our report a lot more wholesome, a lot more complete, and therefore that's our objective. Again, we are not fortune tellers. If I knew what was going to happen to the dollar euro, I would have my billions of dollars and sipping my pina coladas in the Caribbean, but I don't. And I don't think anybody can tell us what's going to happen. Everybody can have expectations, and some people obviously can be more right than the others. But the markets are efficient, and therefore it's almost impossible to predict the markets with 100% accuracy. So what matters is that wholesomeness. So thank you for working with me, and let me know if you have any questions. And I look forward to um, being together again. And please let me know if you have any questions. Thank you. Bye now.